Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
Welcome to Oregon Cash Flow Pro. My name is James Barber. I'm here to help you maximize your cash flow. This is our Wealth Care Wednesday live stream where I'm here to answer any questions that you might have. Financial questions. I guess you can ask me questions about anything. I will try my best to answer it. But mostly this is our financial Q&A, where any financial questions you have, I will do my best to answer them and help provide you with as much value as we can. So if you have questions, put them in the comments section, put them in the chat, and see what we can do here. I go for at least an hour. I will probably cut it off at an hour today because I could feel it in my last meeting. My voice was feeling it today. It's been a long day. David Yadagarians, good evening. Good evening. We're going broke. It was a rough day in the market, I tell you. A lot of red out there today. A lot of red. Way Out West, good evening. BDN, good evening. Break the bank. Break the bank, huh? How are you guys doing this evening? Any financial wins that you guys can report to me? Anything new and interesting in the financial field? Insurance? Anything on your mind? Any burning questions? Put them in the chat. We have a lot of things coming out as far as insurance regulations. Not regulations. Insurance products. New products are hitting the street due to the regulation changes. 7702. We've got some insurance companies that are already putting products out there under these new regulations and putting in the ability for people to put in a lot more money. A lot more money for a lot lower death benefit. It's kind of weird. It's kind of weird looking at it. So I did a comparison for somebody yesterday. I think it was yesterday. We were comparing National Life and Allianz. And Allianz has not updated their 7702 MEC limits yet. They're probably not going to update theirs till the end of the year. But this has always been a really good product, strong financial product for the way I design them and creating cash flow. National Life just updated theirs. National Life, I've been designing better policies than National Life with Allianz for a couple of years now, as far as cash growth is concerned. National Life updated their policies, so we were going to compare them, see which one works better for what we're trying to do. Now, the advantage to the 7702 is if you only qualify for a lower death benefit, you can put in a lot more money if you want to. The downside to this is sometimes people end up liking having a little higher death benefit. And so it's kind of weird when we're comparing the two different products and I design a MEC limit for them and there's a big difference between how much death benefit's needed. So for this particular design that I did, we were comparing the two. With National Life, we were able to do a $50,000 death benefit. $50,000 premium payment annual. And I think we were able to do it for like $900,000 death benefit, something like that. This was somebody who was a little bit older, in their 50s, I think. Not a whole lot of death benefit, but a lot of money that they could put into it. The Allianz product, it was like $1.9 million death benefit. Now you might think, oh, that's kind of nice. I don't care about the death benefit. I would rather have a lower death benefit so the costs are lower. Well, even though the costs were lower in that, the Allianz product still outperformed the National Life product for the illustrations and the projected growth. And a lot of that's because we've got different index options, we've got bonus options, and just in general, I think overall it's a better product for what we're trying to do, which is generate cash flow, generate cash value. So I found that pretty interesting. So when you're comparing the two with the Allianz product, you get more cash value and a much higher death benefit for the same amount of money that you're putting in. Now, when the Allianz products come out and we get a change, we get those changes, you'll be able to put more money in at lower. You could still get a higher death benefit if you wanted to and put that same amount of money in. It just gives you the ability. It doesn't change the underlying cost of the insurance. So these new regulations, it doesn't change the cost of the insurance. It only changes what the government will allow you to put into them without it becoming a modified endowment contract. So it's a little bit of a it's a little bit of a weird thing to see a much bigger or lower death benefit from a couple of different products, and it doesn't really affect the underlying cost other than that cost of insurance. So putting in a lot more money, you're going to be able to do that. I think the biggest advantage to this change is for people who wouldn't otherwise be able to qualify for a lot of death benefit. So if you make a lot of money and you might qualify for a $6 million death benefit, probably doesn't matter because that's a really large mech space even under the old rules. But if you make $50,000 a year, now you're talking about having a mech limit of maybe $1.5 million. That might be pretty limiting on how much money you're able to put in each year for a mech space compared to what some clients want to put into these policies. Oftentimes, I've got folks that want to put in a large portion of their income into these policies. I put in a large portion of my income into all of my policies. So in order to be able to do that, it's kind of nice having that higher mech space. It also will help out when really people truly don't care about the death benefit and you have, say, a large sum that you want to move into a policy. So I've had people who have $500,000 that they just want to move it into a policy and not do much else besides that. Well, we basically try to spread that out over a number of years so that they don't have to buy this massive amount of death benefit. With these changes, maybe we won't have to. Maybe we'll be able to put in larger sums without having to have a big death benefit associated with it. So, some positives and some negatives, but that's our 7702 changes that are being implemented. By the end of the year, all of the insurance carriers are going to have new products out that will reflect those changes. Unfortunately, they're not going to apply to older products. So you're not going to be able to just suddenly dump in more money. I know because I checked. I was hoping I might be able to do that with some of my own policies. Maybe I can just contribute a whole lot more money. I don't mind though because I kind of like the death benefit. I want that extra death benefit. I want to be able to pass that on. I'm not at a point yet where I feel like I have sufficient amount. I mean, I'm doing pretty good. I don't mind where I'm at for death benefit, but I wouldn't mind having some more death benefit. So, Way Out West says, $1,090 on its way to you from California, unclaimed property. Oh, that's cool. Nice. How'd you miss out on that one? So that was money sent back to you, or it's been sitting somewhere, and you didn't even realize it was out there. Way Out West also says, some say more mech space, others say more expense death benefit with the new rules. It's not more expense death benefit. That's the thing. I mean, the underlying cost of insurance doesn't change under these rules. The only thing that changed is how much you can contribute. So let's take the old rules, and let's say you wanted to put in, or let's say you had a death benefit of $100,000. And the cost of that is $1,000 a year. But the mech limit, what you could put into the policy, is $10,000 a year. Now you're going to get $9,000 of paid up additions, or $9,000 of money going into cash value that has the ability to grow with the $100,000 death benefit. Under the new rules, that $100,000 might still cost you $1,000 a year in cost, but you might be able to contribute $15,000 instead of $10,000. So the cost didn't go up, but you could put in more money. So now, instead of 10,000 or 9,000 in there growing, you might have 14,000 in there growing. That's where the difference comes in. So it's not, from what I've seen, it's not more expense on the death benefit. Deep in the money, good evening. Way Out West says, could you please discuss the pros and cons of blended paid up additions versus fixed term riders, 10, 15, 20 years, etc.? Oh, good question. It's not so much pros and cons as what does the insurance company require? That's the way I look at it. As far as the pros and cons, I would say typically how we do a blend with paid up additions, we're blending in some annual renewable term insurance. With some carriers, that annual renewable term insurance is going to go away every time we make a payment. Every time we make a paid up additions payment, it's going to replace some of that. And when that's fully replaced, we can no longer put in extra massive amounts of paid up addition. Other carriers have multiple term riders that allow us to blend in that annual renewable term, and we can let that stay on the policy for as long as you want to. There's no particular end date, at least in any sense of the word where you'll care, because you can get 40 or 50 or 60 years with this blend. We can basically design it to go as long as you want, okay? Some carriers require, because they don't have any other way, they haven't created the ability for an agent to design it to blend in the annual renewable term, so we have to add in the term insurance, the level term insurance, 10, 15, 20 years, in order to get the blend that we want to generate that cash value. So it's mostly carrier specific. I'm not aware of carriers that allow us to just pick one or the other. Might be out there. I just haven't stumbled across it and figured out in my designing, messing around with those. So I think it's carrier specific. Some carriers, you got to blend in that level term. Now the advantage to that level term is that level term is the same cost each year. It's not going to increase in cost each year. Annual renewable term will start out cheaper, but that cost will go up each year. As that cost goes up each year, we're trying to knock it down. We're reducing the amount of death benefit. So the pro on the annual renewable term side is you probably pay less over a shorter period if we cut it off, as opposed to paying for a level term. Because that level term is not going to reduce. That term value is not going to reduce during that term. You're going to pay that same amount the whole time. Whereas with the annual renewable term, we may be paying for less term insurance each year. With the blends that we have that term insurance go for as long as you want to, if you go the full time that the level term benefit goes for, you're typically better off. You have a lower cost with those level terms. So the cost may be slightly lower. I don't think it's going to make that big of a difference in the long run. I mean, it's going to offset with the annual renewable term, having that lower cost up front rather than a little higher cost. You're going to get more money compounding down the road, I think. So, I mean, it's probably 6 of one, half a dozen out of the other. Probably isn't going to make a big difference. That's my guess. Now, maybe you can crunch some numbers and figure out something different. But my guess is it's probably not going to make much difference. Way Out West says, what about lowering the guaranteed growth? Lowering the guaranteed growth. That is going to happen in the whole life policies. I have not seen any new products yet from whole life companies with this new 7702 changes. So it's not just the changes in the MEC limit that came about with these new laws, but there are changes in guarantees among whole life policies. And those guarantees are going from the government requiring insurance companies to guarantee a 4% floor. You get a 4% guaranteed growth. And that's changing to a range. And that range is going to be 2% to 4% or 2% to 3.75%. Because it changes completely, insurance companies are going to have to come out with whole new products. I don't expect those until closer to the end of the year. We may start to see some trickle in prior to that, but they don't need to have them ready until the end of the year. So prior to that, if you like that 4% guarantee, which I like the 4% guarantee, you might want to get a policy sooner rather than later. I don't know if insurance companies are going to offer a 3.75% guarantee. They have the ability to, but maybe they just stick to the 2%. My guess is that the carriers that are struggling to meet that 4% guarantee right now and earn dividends and pay dividends above that, they're probably going to be the first ones to come out with that 2% product. In fact, they may have already done that, and I'm just not aware of it because I don't deal with those companies. They don't have a 150-year history of paying out high dividends, so I don't tend to deal with those carriers. They may have already put out new products. The carriers that I normally work with, who have always paid more than that guaranteed rate, I imagine they're probably going to be coming out with some products at the 3.75% range. They may also offer some products in the 2% range because there's probably going to be a need in there to compete with some of the other companies who are offering that 2% guarantee. I don't know what they're going to give up. I don't know how that's going to change the illustrations. I'm not sure what the appeal is going to be with a 2% guarantee as opposed to a 3.75. It's kind of a wait and see at this point. So I'm sure they'll figure something out that's attractive. That's kind of how they have to stay in business, right? But at this point, I don't know yet. Don't know yet what to expect. Deep in the money, you're starting to speculate with cryptocurrency. Any advice? Be careful. Cryptocurrency is very, very volatile. Watch it. You're going to, specifically Dogecoin and Elon Musk hosting SNL. Okay, so Dogecoin, very volatile, but it's kind of settling into some pricing that we can kind of expect some stabilization around. Where it's still plenty volatile. There's a lot of money to be made trading it. Buying low, selling high, waiting for it to come back down again. The problem is a lot of people are going to be buying into this thing. There's so much hype around it right now. Elon's going on SNL. There's a lot of hype expecting that to be a very big catalyst for Doge. Once that catalyst is gone, this thing could drop in value very quickly. So I expect there may be a sell the news type event that happens, kind of like with 420 Day, which was Doge Day. People thought that was just going to go up and have the biggest day on 420. Turns out, everybody sold off the day before. They tried to beat the news. And 420, it didn't perform all that well. Now, it was still way up higher than it was months ago. But if you're just now getting into this thing, you're going to end up buying near the top. So you got to be careful out there. What I'm doing with it, I have not been sitting on anything. I wish I would have. I really wish I would have. I have a hard time buying and holding. I get bored. So I do trading. I buy it. I sell it. I wait for some action. Like I got bored when it was trading under a penny for a while. Tried to hold on to it for a week or so, and I got out of it. Man, what a bad move, because it's gone up like 500% since then, right? Just this last month. So if I would have just bought and hold it, I would have been great. And that might be the case for people that are getting into it right now. If they're just buying and holding, might be a good way to approach it. However, I pay too much attention to the market, and I realize that there are going to be times where it comes down. So what I'm doing, I started doing this a couple of days ago on it. I buy in for a little bit, it goes up, I sell the exact same amount that I bought in for, and I leave the profits in. And what I'm doing is I'm accumulating actual Dogecoin instead of paying attention to the dollar amount. Now that's going to be hard to continue doing because at the moment I'm up $500, 500 and change on it, which means I'm up. If I just left that in there, the number of Dogecoins I have is close to 1,000 Dogecoins. I have close to 1,000 coins. I think it's 800 and some odd that are totally free. Like they're the profits I made from putting money in and taking it out has given me those Dogecoins. So I could just sit on those 800 to 1,000 Dogecoins and it won't matter where the price goes. And I'm hoping I might be able to do that. But if it gets up to $1, and now I'm sitting on $1,000 worth in there come Saturday, and I think there's going to be a sell the news event, I'm probably going to sell it, buy back in later, because I just have a hard time not doing that. So let's see. In general, crypto is a good investment like Ethereum or Bitcoin. It doesn't feel super safe. Maybe it's the way you're looking at it. It's not super safe. That's what volatility does. I mean, when something goes up and down massively, it's not going to feel safe. Now, if you got in way low and it's all like 1,000% profit, you're going to feel pretty safe because it's got to go down a long ways in order for you to lose all of your gains. But it can happen. So you got to decide, as with any investment, you've got to decide at what point do you feel like you're better off taking it out. For a lot of people that have the ability to keep it in there, they can keep it in there until losing that money would hurt more than keeping it in there for some possible gains. Or if it's a life-changing amount of money. If you have a life-changing amount of money in there, there's no reason to leave it in there and lose it and lose the ability to change your life with it. I mean, that's literally what we mean by life-changing amount of money. The amount of money that you've built up in there can change your life. If you take it out and you pay off your bills, you pay off your house, you go on vacations, whatever the case may be, it's going to change your life. Okay? So if you have life-changing amount of money in there, you might want to pull some of it out, right? And change your life. If you can afford to leave it in there, if you can handle the volatility, you're welcome to do that as well. You're going to have to decide at the end of the day, what's the best strategy for you? Just realize this stuff is very volatile. No idea what it's going to do. Okay, Way Out West says, was sitting in escrow from a home purchase in 1998. Oh, nice, nice. Well, that kind of stinks that they didn't give it to you back then. At least you got it now. But what could you have done with $1,000 over the course of the last 20 years? Probably could have put it to work pretty good. Way Out West, could you clarify what I mean by the potential limitations when the one-year term is burned off? The potential limitations when the one-year term is burned off. That only happens in it happens in whole life. Okay, it doesn't happen in IULs, but in whole life, when that term insurance goes away, so does your ability to contribute what I call the 10x paid up additions. So if we have a design that's a 90-10 design or an 80-20 design or whatever the split is, that 80 or that 90, that's our paid up additions. Okay? When you run out of term insurance, your ability to put in that 80 or 90 goes away. So you're going to be limited to that 10 or the 20 or a little bit higher than that. So those are the limitations when that one-year term runs out. So you always want to try to make sure that that lasts as long as you're wanting to make those very large payments. And that's going to be a personal choice. I've got some people who like to just max fund this thing over 7 years, and that's it. Like, at that point, we're going to be aggressive in funding it to the MEC limit, knowing that in year 8, it's going to drop down and I only have to fund that very small amount. Okay? So that's one thing. I have a lot of people who like that type of design. I have other people who want to pay for it as long as possible. And so we just tweak it. We just tweak that blend. We tweak how long that term insurance is going to last. We might have to adjust how much insurance we're paying for. It depends on the carrier. But yeah, there's things that we can do to make it last longer or shorter, depending on what your needs are. David, we're all going broke. Well, we're not all going broke, but we are struggling. We are struggling a bit in the market when we have these bad red days. Eugene Murray, good evening. You know premium equals base plus 1-year term, plus PUA. Can I discuss structured versus unstructured PUAs and how these are used in policy design? Okay, I think you mean scheduled and unscheduled PUAs. When it comes to some insurance companies, they give us the ability to contribute on a schedule or unscheduled. When we make our payments, we either make our payments on a set time frame, or we can dump in money whenever we want throughout the year. With whole life companies, Guardian allows dumping in whenever we want throughout the year. Mass Mutual, Penn Mutual do not allow that. They have set time periods where we can put money in, typically our anniversary period. These are companies that want to know how much are you giving them each year. Guardian, they're really flexible. They basically have the flexibility of an IUL. Your IULs, you have the flexibility to contribute on a set schedule of whatever amount you want to be tied to, and you can dump in up to the MEC limit whenever you want throughout the rest of the year. Same thing with Guardian. So we can do those things with certain carriers that we can't with others. So that's the difference between scheduled and unscheduled. Scheduled, we tell the insurance company when we're going to give them money as new premiums, and they're going to expect it on that time frame. Unscheduled, we're just going to send them money whenever we feel like it. We're dumping it in at some point throughout the year when we get cash. So we've got some people who have plenty of money and they know exactly when it's coming in and they can do on that regular schedule. I have other people, commission earners, they don't know when they're going to get their big heyday. Real estate investors, real estate agents, life insurance agents, insurance agents in general, like people who get paid on commission, it's like you make a lot of money in one month, you make a lot less in another month. So it works out really good when we design the scheduled payments to be very small, but they can dump in large amounts whenever they want to. It's a really great way to do a design on some of these things. It gives a ton of flexibility for people to be able to contribute. And my number one thing when it comes to deciding which carrier to go with is flexibility. How much flexibility do you need? We want the carrier that we choose to have the ability to meet that flexibility needs so that you can contribute as much as you want to these policies. It doesn't do as much good to go with a carrier that's really strict but limits you to contributing a tiny amount, even if they might, that tiny amount might generate more in returns than a tiny amount in another flexible company. But with the flexible company, you can put in 10 times as much money because of the flexibility. You're going to end up with way more cash value down the road if you could put in 10 times as much money as opposed to a little tiny amount that might earn a slightly better dividend or a slightly better interest rate. So a lot of things to take into consideration there. Good questions. Let's see, deep in the money. In general, is crypto a good investment like Ethereum or Bitcoins? I don't know. It's hard to say. It's hard to say if it's a good investment. It's not really an investment per se. I mean, it can be. People treat it like an investment. It's more like a place to store funds. You're hedging against inflation. You're hedging against other costs, other things that are rising. It functions kind of like gold does, where it's a hedge against inflation. It's a place to store your value. It just so happens to be increasing in value right now. It goes up, it goes down. I hesitate to look at it as an investment because there's nothing underlying it. There's nothing other than the belief that people have in its value, that it's going to maintain that value. It's not like a company that generates income, that owns assets, has a balance sheet, has requirements to meet shareholders' needs, to do business in a way that benefits their shareholders. Okay? Crypto doesn't have any of that. So you got to be careful with it. People can make money in it. It can be a good store of value. But you got to realize what it's useful for. And then you got to figure out what matches your I want to say investment philosophy, even though I just said I don't really treat it as an investment. You got to realize what matches your personality. Certain coins you may just be more attracted to certain coins and what they offer. Okay. Certainly the safer coins are Ethereum and Bitcoin. Now Bitcoin's at close to $60,000. It's way up there. If Bitcoin were to go down to zero, I mean, I don't think it would go down to zero. If Bitcoin were to drop again, let's say down to 10,000 or less, entirely a possibility. It's not out of the realm of possibility. That's a pretty big drop if you've got $64,000 in there. Now, some of the other ones are lower cost, but as a percentage, if you have $64,000 in there, they could lose just as much value, maybe more, if they don't have the same underlying characteristics that attract it to many, many investors. The advantage that Bitcoin has is many people are trading it. Many people believe it has some value. More and more institutions are getting in on it. Same thing with Ethereum. More and more institutions are getting into these. Ethereum has a really good blockchain. It is used for a lot of different things. So there's a reason these things are popular. So more than just, oh, there's a coin, let's invest in it. You don't want to just do that because there's nothing underlying that value other than what people hype it up as. I mean, how many people can you convince that this is worth more than it is so you could sell it to them down the road? That's basically what a lot of these new coins come down to, right? So you got to make sure there is at least some functionality there. That functionality provides more value. If you can actually buy goods with it, that provides more value. Okay? Some coins, you can only trade those coins among other coins or for fiat currency. There's not much to that. So be careful out there. CDG. Have I done any stress testing comparing the performance of Allianz and National Life Group or others, like running each at 70% of their respective AG49A max rates? You'd be interested to know if Allianz still wins. I have not done that. There's a reason I haven't really done that. When I do the illustrations, we get to see the guaranteed values. We get to see the current values, and we get to see something in between. I don't consider running the illustrations at just a lower value a stress test, because realistically, if something goes wrong in these policies, if the indexes don't perform, we're going to do some things to mitigate this. So when I look at these policies, I'm looking at the overall policy charges with the way that I design it. How can I minimize those costs at the beginning and throughout the life of the policy? If an index isn't performing, I will get out of that policy. We can do a 1035 exchange. I might just change the index options within that policy if the overall product is a good product. The only problem is the index isn't performing. I may just reduce the death benefit. I may bring the costs down. So if for some reason the insurance company, or let's say all insurance companies, decide to start raising the rates of the underlying insurance, we can just reduce the death benefit as long as we have that space and not cause a mech. So there are things that we can do inside these policies to mitigate if there's problems that happen. So that's why I don't really stress test them. I want to go with the product that gives me the most opportunity and looks like, according to the illustrations that we've got, has the lowest cost. And Allianz gives me the ability to design these with a lower cost than the other ones. A lot of that is just because of the blend that it allows. When it comes to blending in, and I've got a video coming out talking about blended IULs, but that'll come out next week while I'm on vacation. When we blend IULs, we blend base face amount with some supplemental term insurance, sometimes called additional protection benefit. There's all kinds of names, but it's just additional annual renewable term insurance. And the reason we blend those two is because the base face amount pays a commission and the supplemental term does not pay a commission. So we're able to reduce the underlying costs in that policy. Most carriers will limit us to a 2-to-1 ratio or 3-to-1 ratio. Mutual of Omaha, it's a 2-to-1 ratio. So if I've got 100,000 death benefit that pays a commission, I can blend in 200,000 that doesn't. Some other carriers, like National Life, lets me do a 3-to-1 ratio. In fact, most carriers allow a 3-to-1 ratio. That means 100,000 death benefit pays a commission, 300,000 that doesn't, 400,000 total death benefit. This is the type of blends that allow us to reduce the cost in the policy. Allianz lets me do way more than any other carrier. I can blend in 10 times that base premium. So I can do a $100,000 death benefit and I can blend in a $1 million on top of that. So I make the same commission whether I sell a $100,000 death benefit or 1.1 million. And by limiting that commission, that brings those underlying costs down at the beginning of the policy by quite a bit, boosting the cash values and the amount that you're able to grow the policy. We manage the policy later on down the road by keeping the death benefit down. So that cost of insurance matters as you get older. Now, when we put those blends in, we can see what those costs are in the policy. So I'm comparing, when I'm looking at National Life and Allianz or other carriers, I'm comparing the cost of that insurance as I get older in the policy. Now, of course, there's going to be different max guarantees, how much they can adjust those rates. They're not going to be very much different, though. So as long as those underlying cost of insurance is good, I'm happy with that carrier. I know I can mitigate my costs. I like Allianz. That's the one that I like right now. That's my favorite one. Hope that helps. Good question. Man, that was a good question. Way Out West says, for a 12 or 13-year-old, what's the minimum per year to fund an IUL that makes it valuable for them in the future? What's the max you can fund an IUL for someone that young? The max you can fund an IUL is going to depend on their parents because the death benefit determines the MEC limit. With the new 7702 changes, the MEC limits are going to be a lot higher for younger people. So those are going to make more of a difference for younger people than older people from everything that I've seen. But we can get a good design that pays out good money in old age on a kid when they've got 50, 60 years of compounding ahead of them for as little as $100 a month. 12 and 13-year-old, you could do $100 a month. It's going to look pretty good when they get older. Now, if you want a substantial amount, you might bump it up to $200 or $250. I'm currently putting in $250 or the equivalent of $250 a month on my two girls. And that's going to turn into $100,000, $200,000 potential payout every year in retirement for them, assuming the index performs as expected, or actually expect it to perform better than illustrated, but let's say as illustrated, okay? Really good potential growth, even with just $1,200 to $3,000 a year. If the parents of the kid have a very high death benefit, your kids can qualify for half of the death benefit that the parent has. So if you've got a parent that has $4 million in death benefit, a kid can get $2 million in death benefit. You might be able to pay in $10,000 a year into a policy like that. With the new MEC changes, maybe more than that. So it varies. So there's not just a max that you can fund an IUL at. It's going to depend on the MEC limit. MEC limit adjusts depending on the death benefit, their age, health, well, not the health, but their age and their gender makes a difference. So all of that plays a factor in it. Jennifer Ning, what about Nationwide IUL? I just got appointed to Nationwide. I just contracted with them. I have not had a chance to play around with their IULs. I will report back after I get a chance to play around with them. The IULs that I've been seeing from other agents are horrible from Nationwide. Massive, massive costs inside these policies. So they're not good. Like I don't have a high opinion of Nationwide. They sell a lot. I haven't seen any good designs from it. So I decided I'm going to get contracted with them so that I can try and see how good of a design should I be seeing these policies from Nationwide look like. What can these agents be doing that they're not doing when they're designing these terrible policies with massive surrender charges? Massive surrender charges. Now, surrender charges, they only take effect if you give up the policy. But it affects your liquidity in the early years. It affects how much cash value you have. And I've seen too many Nationwide policies where people have put in tens of thousands of dollars into these policies and had no access to cash value even after 5 years. Horrible, horrible designs that I've seen in some of those policies. So, once I get on there, I just haven't had time, but I'm going to try to figure out what's the best way I can design their policies, and I'll be glad to report back to you. The reason I wanted to contract with Nationwide, besides that, is I heard they already instituted the 7702 changes. I'm always on the lookout for a way to provide more value to you folks. I know Allianz is not going to make their changes until the end of the year. That means there might be another carrier out there right now that you might want to get into that you can contribute a lot more money. Maybe that product will work better for you, at least in the short term. Now, from my regional director, he said he plugged in a bunch of numbers from a bunch of different carriers that have already instituted the 7702. Allianz still outperforms them. It's that good of a product. You know, there's a reason I'm pounding the table for the Allianz product and why it's been so attractive to me. Way Out West, thoughts on Penn clearly outperforming Guardian Mass Mutual for the same person and premium. Yeah, I think my interpretation is it likely has a lower cost of insurance. I think Penn Mutual has a lower cost of insurance. We end up with slightly lower dividend than Mass Mutual, slightly higher dividend than Guardian. I can't do a 90-10 design with it. I can only do an 80-20 design with Penn Mutual. So it takes a little bit of time to catch up. But once it catches up, according to the illustrations, it's going to outperform both of those two in the long run. So Mass Mutual and Guardian, I can get 90-10 design. We can get you really high cash value in the first year. I can't get quite as high with a Penn Mutual policy. So while it may start out a little bit behind, it does ramp up pretty quickly. Now, part of that might be how they pay out their dividends as well. And they may commit more dividends to paid up additions than Guardian or Mass Mutual. Because when we do that high blended design, we get less dividends. We still get a lot bigger growth because we're working on massive more cash value. When we're comparing Guardian to Guardian and a 90-10 design to a 60-30 or 60-40 or a 70-30, the 90-10 design outperforms it big time. In the long run, big time. Mass Mutual, compare the 90-10 design to any other blend design, outperforms it big time. Penn Mutual, 80-20, best design I can do. When I compare the 80-20 design to a 60-40 design or 70-30, the 80-20 outperforms the other ones big time. So we're way better off going with as much blend as we can do when we're comparing inside carrier to carrier. But when we start comparing one carrier to the other, all of those underlying things make a difference. The underlying cost of insurance, how the dividends are factored into it, how they're going to pay out. The current dividend rates obviously make a difference. So all of those things matter. And yeah, I mean, illustration-wise, Penn Mutual outperforms both of those. I really like Penn Mutual. I'm hoping to get a policy with them soon, but the downside is they're not very flexible. They're like Mass Mutual. You got to know how much you're putting into that policy each year. So it kind of limits the appeal depending on the client. It does work for some people. If you don't need the flexibility inside the policy for contributions, I keep recommending people go with Penn Mutual. Because we do get the best illustrations. But I still sell way more Guardian and Mass Mutual than anything. Just Mass Mutual doesn't have the flexibility either, but I get a lot of people that early cash value is one of the biggest keys. Like real estate investors I work with, they want all that cash value available. You know, they don't care about a tiny percentage difference growth over 30 years in these policies when they can get, if they have access to extra cash, it can cost them a deal that they can make 300 or 400% on. So for them, early cash value is king. For other people, not quite the case. So everyone has their own needs, and we just try and match it up best. Try and match up the need to the policy and the person. Let's see. You've seen the Penn policy you're referring to, and the Guardian Mass Mutual were designed by IBC Global, so you know it was done right. Penn overly optimistic projections? No, I don't think that's the case. I don't write it off as that case. I think the difference comes down to underlying cost of insurance and the dividends. I think it's as simple as that. It just takes some time. Penn Mutual takes a little bit of time to ramp up. Once it does, it's going to perform really well. Part of it has to do with how the blend goes, that term blend. Guardian, we can't do the same kind of blend. Guardian has one type of term insurance that we can blend with those, and it goes away in 7 to usually 14 years. Not much I can do about that. With Penn Mutual, I can get that blend to last 40 years if we want to. So it just depends. Way Out West, thank you. I appreciate the tip. Great content as always, he says. Thank you. I need some water. My voice is really feeling it. I'm definitely going to have to cut this off when we hit an hour. I got 13 minutes left. Get your questions in. I'm going to answer them as best I can until my voice is gone. Jennifer Ning says, thank you. Good to know. You're welcome. You're welcome. Way Out West, it's unfortunate the dividend payouts are super secret sauce. They are to an extent. So if you own a policy, you can request from the company how your dividend is being paid out. So if you own a policy from each of those companies, you could probably ask for it. I have seen Guardians for one particular client because they asked for the formula, for their formula. They were able to provide that for that person. They don't provide the formula for everybody because it changes. Like, the formulas are secret as far as how they decide to split it up between base premiums, paid up additions, term insurance, annual renewable term insurance, health, age, products, how many years you have left on your policy, because they're using their dividends in order to make sure that the premiums that you're paying are going to equal the death benefit at the end of the contract, when that contract matures. That's the number one goal of how they distribute their dividends. So if you have a base premium of $3,000 and your death benefit, your whole life death benefit, this is the base premium, your whole life death benefit is $200,000. They're going to give you enough dividends throughout your lifespan that you're paying this contract, so that $3,000 a year will eventually equal the value of that $200,000 death benefit. And so they're going to adjust the dividend payouts to make sure that stays on track. That might mean if for some reason something falls behind, later on they're going to give more dividends to that person so that it gets back on track. Like, they're going to allocate more of that dividend payment to that person. So it's my understanding there could be a wide range of differences in how much dividend goes out to each person. Kind of crazy, but yeah, that's why it's a super secret sauce. Yeah, I don't think there's any catch to Penn. I don't think there's any catch. CDG says, it seems the accelerated underwriting is typically offered for qualified individuals when applying for IUL policies. Is accelerated underwriting offered very often for whole life policies? Yeah, everybody has an accelerated underwriting program. And for the most part, they have their criteria that you've got to meet. Most of the accelerated underwriting programs I'm aware of, that criteria involves a death benefit of $1 million or less. If you're asking for less than $1 million, you can apply for the accelerated underwriting. If there's no underlying health issues, you can qualify for the accelerated underwriting. That means no medical exam, right? Accelerated underwriting is just no medical exam. They may still order an attending physician statement. They may not. It's really accelerated if they don't. Penn Mutual is supposed to have a really good accelerated underwriting program. Like, they make decisions very quickly sometimes in as little as 2 days. There are some carriers out there that say they'll make instant decisions. You typically pay more for those. You typically pay more if there's less or lower or no underwriting involved. Not underwriting, if there's no medical exams involved or no medical underwriting. They're always going to try and check your prescription records and things like that. But the more that they limit what happens, that's why it is accelerated, because they're doing less underwriting on those policies. So there's usually a little higher cost. So yeah, I mean, there is accelerated underwriting for whole life policies for sure. Whew, I'm feeling wiped out. My voice is about gone. We've got 8 minutes left. Hit me up with the best questions you guys got left, because I'm cutting you off in 8 minutes. And in the meantime, I'm going to see if I can get some more water and ease my throat. I might miss our Wealthcare Wednesdays next Wednesday. I'm going to be out of town. I finally get a vacation, going down to Mexico. Gonna soak up the sun. Do some snorkeling. I love snorkeling in warm water with lots of wildlife, lots of fish, turtles, octopus, octopi, squid, whatever there is down there. I've seen an octopus. I've seen a turtle. I had a barracuda follow me one time. That was interesting. I didn't know it was a barracuda. And I didn't realize that they're very dangerous. It followed me for quite a while. I was like way out around the side of this island. I was down in the Caribbean, and this barracuda just started following me. And I noticed it behind me, and I would turn around, and it would turn around. I did a video on it. It's in my channel. I forget which one. I forget what I did on it. But I would turn around in the water, like I would swim towards it, and it would be facing me, and then it would turn around, and it would kind of swim away, keeping its distance. I'd turn around, and I kick forward some more, and it would turn and follow me again. Apparently they got razor sharp teeth. They can be dangerous. But it was pretty big. It was a couple of feet. It was at least a couple of feet big. Maybe more. I forget it now. I can't picture it. But it was pretty large. And it just kept following me. It eventually went away when I went back to shore. It went away. Didn't ever cause a problem. But it was kind of neat. I got some pictures of it. Way Out West says, best exchange rates in Mexico are from the ATMs. Stay away from airport or any currency exchanges. Oh, good to know. I wasn't planning on doing any currency exchange. We're just going to bring some dollars with us, tip in dollars, and pay in dollars. But that's interesting that the ATMs give the good exchange rates. I think I had heard to stay away from ATMs. CDG, have insurance companies started asking whether you've had a COVID vaccination? No. Nope, they have not. And they may not be able to. I think they might be restricted from taking COVID into consideration. I know they're restricted, that like COVID is not a reason for a denial of an insurance claim. I know it's not a reason for a denial. If you're going to travel to a place that has COVID breakout, like I've got somebody who may be traveling to India soon, they're not even going to offer them anything until they get back and they've gone through 14 days of quarantine. Big breakout in India right now. So, a lot of risk. I haven't seen anything about COVID vaccinations, though. So it'll be interesting if anybody goes through a medical exam and hears something different. I have had Guardian, the exam company that does that, will do a free COVID test. I think it's just a cheek swab test, but they'll do a free COVID test along with the exam if you want it. It's not something they'll just automatically do, I don't believe. I think you have to I think they just offer it. Way out west, bank to bank rates. Credit cards are the best way to pay for stuff. Do not use your ATM card. That is also a Visa or MasterCard. I wasn't planning to. Yeah, banks are not required to pay off fraud with an ATM. That's right. Credit card companies pay everything, no sweat. Yep, that's the plan. The plan is to use credit cards and cash. Appreciate you. Appreciate your advice there. I know you've definitely spent way more time traveling than I have. I have limited experience traveling outside the country. I've been to Mexico before. I've been to near the area that we're going. I've been to Canada a couple of times, to Canada and the Caribbean. That's it. That's my experience internationally. Tried to get out to Europe last year, but COVID shot that down. We had a month-long trip planned in the summertime. We were going to take our kids, expose them to a lot of what Europe has to offer, fly into England, go to London for a few days, travel down to Italy, and then stay in Switzerland for a couple weeks. That was going to be our trip. Foiled by the pandemic. Hoping we get a chance to do that next year, because all the flights that we had to put off are likely going to expire. The value that we get from those, we need to use those within a certain time frame. Way out west, Mexico, pictures or it didn't happen. I'll do even better. I'm going to do some live streams from down there if I'm able to. So I plan on doing some videos and still interacting with you fine folks at least a little bit. We'll see what the extent I can do down there. I'm not sure exactly how my AT&T will work. If I get free internet with my AT&T while I'm down there, I'll be able to live stream when I'm away from the hotel, or maybe even at the hotel but at the beach if I have good signal. Otherwise, I might have to wait until I'm at the hotel. I could do it on Wi-Fi. So, you've been to more countries than states, you think. 90% was for business. Ah, gotcha. That's nice. I like the idea of doing a lot of traveling, learning different cultures, being exposed to different cultures and peoples. Seems like a lot of fun. A lot of experiences I've missed out on that I hope to engage in as I get older. And with that, we've got 1 minute left, but I am done. My voice is done. I thank you guys for joining me today. I won't be back next Wednesday. Most likely, I might. I won't rule it out yet. But otherwise, we'll be back in 2 weeks. We'll do our Wealth Care Wednesday in 2 weeks. Be sure to save up your questions. You can always go to my website, OregonCashflowPro.com. You can leave a voicemail question for me that I can play during this. Nobody seems to want to leave a voicemail message for some reason. At least I haven't been notified that I've received any. So if you've left some, let me know, because I haven't seen them. But I would love to play a voicemail message during our live stream and answer it if you feel like leaving one. I always welcome you guys to join our Discord channel. We have a Discord, private Discord. You have to become a YouTube channel member or a patron to join it. So it helps to support the channel. You can join it for as little as $1. So $1 a month helps to support the channel, and you get access to all the fine folks that are in our Discord. They talk stocks, they talk options, we talk insurance, cash flow, whatever you can think of. There's a place in there to talk about it, hopefully providing some value that more than pays for that $1 that you pay to get in there. And the reason I charge $1 is because that little tiny hurdle keeps the trolls out. We don't have anybody that trolls in there, so it's really awesome. It's a great place. So thanks for joining us. Hope to see you in the Discord. I will be in there during my vacation from time to time, following up, answering questions if there are any, making sure that people are attended to as necessary. But thanks for joining us. In the meantime, go maximize your cash flow. We'll see you next time. Not that one. There we go.